हाँ नासिर, कुछ अर्जेंट है तो बोल, वरना हमको अर्जेंट है तो बोल, मैं क्लास असल ने शुरू कर दी है। बोलो। हाँ वो रात में बताता हूँ, चल आगे बोल। मतलब 60। हम्म। हम्म। पहले जा रही थी वहाँ क्या? तुम्हें क्या लगता है क्या बेहतर होगा? क्या फुल स्क्रीन ज़्यादा बेहतर है? सही है, ले लो। आपने तो ये शेयर कर दिया, फुल तो नहीं शेयर किया आपने। पोर्शन ऑफ द स्क्रीन पे अगर वो मसला करे तो आप पोर्शन ऑफ द स्क्रीन करो ना। तो अभी आपने ये शेयर ही नहीं किया, दोबारा करो। मेरे ख्याल में आपने गलत शेयर किया, आपने स्क्रीन ही, हाँ आपसे नहीं नहीं नहीं। पूरी कंप्लीट हो गई ना सर। Okay, hi guys, I hope you're doing well. Can any one of you just confirm to me if I'm audible? Yeah, can any one of you just confirm to me if I'm audible, please? Okay, I'm sorry to have kept you waiting, but anyways, we are just gonna start off. So, welcome to this SBR revision marathon session. Before I proceed, let me just introduce myself. A lot of you people already know me, but again, my name is Luqman Rafiq, and I have been in teaching profession for more than 13 years now, teaching different subjects for different qualifications. With respect to my ACCA teaching, I have been teaching the financial reporting, financial management and performance management subjects for the last 12 years, and I've been teaching at the highest levels, including the different international organizations, plus I've also conducted webinars, global webinars on multiple occasions for ACCA also. So our whole agenda and whole objective of this session of today is that we are going to inshallah try and go through the maximum portion of the SBR so that it acts as a quick revision for you people. So I've written down few things in advance so that I can actually help you people out with this. So basically, let's just start off. I'm going to start off discussing this SBR revision marathon. My whole objective is going to be that I want to revise the whole of the syllabus, and hopefully inshallah we'll be able to do it in 3 hours time. Just in case if it exceeds, we are going to go beyond that also. Till the time you are determined, till the time I have the stamina, we'll just go on and we'll just continue with this. Okay guys, so basically with respect to this SBR, ये ना ऑप्टिमाइज करना पड़ेगा, प्रॉब्लम हो रहा है। बहुत ज़्यादा लैग कर रहा है, बहुत ज़्यादा लैग कर रहा है।
शुरू भी नहीं करना, 4 जगह से क्लियर कर रहा हूँ।
Okay, I hope that it's clear now, hopefully inshallah. Okay guys, so basically the first thing that I'm going to start off is the group accounts. Let's have a quick discussion. Let's have a quick discussion about the group accounts. So as we talk about the concept of group accounts, what exactly is there with respect to group accounts? So you know that there are multiple accounting standards that constitute, that are part and parcel of the group accounts. What are those multiple accounting standards? That include IAS 27, which is about separate financial statements. Then you've got IAS 28, which is about the associates and joint ventures. You've got IFRS 3, the business combinations. The IFRS 10, consolidated financial statement. IFRS 11, which is about the joint arrangements. And lastly, you have got IFRS 12, which is about the disclosures pertaining to the different group related accounting standards. Now, let's just start off with one by one. So basically, when we have got this IFRS, which is IAS 27, so what exactly is this IAS 27 separate financial statement all about? When I talk about the IAS 27 separate financial statement, the whole objective and the agenda of IAS 27 is that it is applicable to the individual financial statement. It is applicable to the individual financial statement of the investor. Like if you have got an investor who has acquired a subsidiary, if you have got an investor who has acquired an associate or who has invested in some entity, so individually he would record an investment. So that individual or the separate financial statement would be prepared under IAS 27. Now what does IAS 27 says? IAS 27 says that basically your investment in your subsidiary, associates, joint ventures, etc., etc., all of these investments, what you need to do is that you can actually show them. You can actually show them in your financial statements at cost, or as at fair value through P&L, or as at fair value through OCI, or even there is one more treatment that is allowed, which is you could show it as using the equity method of accounting as allowed for under the IAS 28. Now what exactly do you mean by this? Let me just guide you. For example, as a parent entity, you invest in a subsidiary. So when you invest in a subsidiary, maybe you invested in a subsidiary for $100 million. So what are you simply going to do? You're simply going to do it like this. You're going to do it like this. What are you going to do? You're going to say investment debit by 100 million and the cash credit by 100 million. You're going to say investment debit by 100 million and you will say the cash is credited by 100 million. इसको ज़रा जो ना वो हाइड कर दो इसको. डिनाई करो इसको, ये इसको यहाँ रख दो यार, नीचे रख दो, बस सही है. Okay, it's connected now. I'm sorry, I think now the things have been fixed. Okay, so let me just start off again. Basically, as I said that when you invest in a subsidiary, so what are you simply going to do? You're going to say investment debit and you would say the cash is credited. And in your individual, the separate financial statement, this investment you have a choice. You can continue to record it at the original cost. You can continue to record it as at fair value through P&L. Or you could record it as at fair value through OCI, or you could even account for it as an equity method of accounting. Now just try to understand. You know what a fair value through P&L is, which is remeasured to fair value at each reporting date. The gain or loss has to be taken to P&L. What is that fair value through OCI? Remeasured to fair value at each reporting date. The gain or loss has to be taken to OCI. Now as an entity, what you need to do is that you need to make sure that the whole class of investment should be recorded using same method. Now what exactly do you mean by this? This actually means that, for example, if you are investing in one subsidiary and you are investing in another subsidiary, third subsidiary, fourth subsidiary, let's say if you've got 4 subsidiaries, what exactly are you going to do? You're going to make sure that all 4 subsidiaries, the subsidiary 1, subsidiary 2, subsidiary 3, subsidiary 4, every single subsidiary has to be recorded at fair value through P&L if one subsidiary is recorded at fair value through P&L. If you are recording one associate as at fair value through OCI, then you got to make sure that all associates, all investments in associates should be recorded as at fair value through OCI. So one of the accounting standard with respect to group account is the IAS 27, which is about separate financial statement. Now from the perspective of the examination, you know this thing, that usually question number 1 of the SBR is about the consolidation. It's about the group accounts. So when we talk about question number 1, what actually happens, try to understand. With respect to question number 1, what actually happens is that the examiner gives you different type of scenarios and he requires discussions. So if he requires discussion, he could come up with a scenario where the investment in the individual financial statement had been recorded at XYZ amount, and then he might actually require you to rectify the accounting treatment or things like that. The second accounting standard is the IAS 28, and the IAS 28 is about the associates and joint ventures. So when I talk about the concept of an associate, when we talk about the concept of associates and joint venture, so what happens with respect to associate, what happens with respect to a joint venture? An associate is an entity upon which you exercise significant influence. It's an entity upon which you exercise significant influence. And what exactly do you mean by significant influence? The significant influence is simply your power to participate. Your power to participate in decision-making process, that is considered to be significant influence. So you've got one investment which is an investment in associate, and what's an investment in associate? An associate is an entity upon which you exercise significant influence. What is a significant influence? It's a power to participate in decision-making process. Now how do you get the power to participate? So power to participate in decision-making process, you get it by actually having a representation on BOD. So when you have got a BOD representation, that's actually power to participate in decision-making process. The second thing is that IAS 28 also covers up another area, and that area is about the joint ventures. We are going to discuss these joint ventures a bit more as I move forward to IFRS 11, but let me just give you a bit of an idea that what a joint venture is. A joint venture actually refers to an entity which is subject to joint control. A joint venture refers to an entity which is subject to joint control. That's what is considered to be a joint venture. Now when we talk about the IAS 28, in accordance with IAS 28, whether you are accounting for associate or whether you are accounting for a joint venture, just make sure one thing. What is that one thing? That is basically that with respect to this associates and joint venture, you actually do not consolidate. I repeat, you do not consolidate. So what do we do if we don't consolidate? We account for them using the equity method of accounting. We account for them using the equity method of accounting. Now what exactly do you mean by the equity method of accounting? Try to understand that. When I talk about the concept of equity method of accounting, so under the equity method of accounting with respect to balance sheet, with respect to SOCI, all that you do is that you just present a single line item. What's a single line item with respect to the SOFP, which is the balance sheet? All that you do is that you write down a heading which is investment in associate. What do? You just write down a heading which is investment in associate. Now what exactly do you mean by the investment in associate? So the investment in associate is recorded like this. The investment in associate is recorded like this, which is cost of investment. It's a cost of investment, and what do? You actually add up, and you add up share of post acquisition profits. You add up the share of post acquisition profits. So what do? You say cost of investment, and then you add up the share of post acquisition profits. Now, what do you mean by share of post acquisition profits? So the date since you acquired this associate till this date, what you are simply going to do is that if you have got a 40% stake in associate, so you'd say 40% multiplied by post acquisition profits. You'd say 40% multiplied by post acquisition profits. Now what next is there? The next situation is basically with respect to the statement of comprehensive income. Again, with respect to statement of comprehensive income, there is a single line item, and that single line item is the share of profit from associate. That single line item is actually a share of profit from associate. Now what exactly do you mean by having a share of profit from associate? Try to understand that share of profit from associates concept. When we talk about the share of profit from associate, the share of profit from associate would be simply calculated like this, because you know the income statement is done for the period. It's for 1 year maximum, right? So for example, if you have a year end, for example, if you have a year end of 30th, or let's say just keep it simple, if you have a year end of 31st December, let's say, and you have acquired a subsidiary for, let's say, on 31st of March. The acquisition date is 31st March. The profits of this subsidiary for the year are, let's say, $100,000, and you have acquired 30% stake in this subsidiary. So what are you simply gonna do? Just try to understand. What you are simply gonna do is that you're gonna say that share of profit from associate is going to be 100,000 multiplied by 9 divided by 12 multiplied by 30%. So that's what you're going to do. That's what you're going to show in the financial statement. So basically you're going to say what? You're going to say 100,000 multiplied by 9 divided by 12 multiplied by 0.3 gives you 22,500. So that's a single line item that you would show in the single line item that you would actually show in the consolidated statement of comprehensive income. So what are you going to do? You're going to show this single line item in the consolidated statement of comprehensive income. Now let's move a bit forward about the third accounting standard. One thing that I actually forgot to tell you, that as we talked about IAS 28, it's the investment in associates and joint ventures. So when we talk about the investment in associates and joint ventures, so same accounting entry, same treatment is there for the associates, and the same treatment is there for the joint ventures. Now, I've got somebody, Vivek Sethi, what would be the double entry for the profit? Okay, if you want to see the double entry for the profit, here you go about the double entry. For the double entry of the profit, all that you have to do is that you would have to say investment in associate debit, profit and loss account credit. Investment and associate debit, profit and loss account credit. That's what you are actually going to do. Investment and associate debit, profit and loss account credit. That's what is going to happen. इमरान सही है सब? हाँ सही, आप जाओ। सिर्फ एक काम ये करवा दो, उसको ये बोले यार एक एक्सटेंशन वायर लगा दे ताकि यहाँ चार्जर मैं लगा दूँ थोड़ी देर बाद ना, अभी ज़रूरत नहीं है फ़ौरन से। सही। Okay guys, the next one of them is basically IFRS 3 business combination. Now, a lot of people when they study For those of you who have joined in a bit late, number one, the recording of this webinar will be available, number one. Number two, this is presently being streamed live on the YouTube channel of Scriber and myself also. And it is also being streamed on the Facebook pages of myself and Scriber Academy. So you could just go on to Facebook or YouTube, you could search me, Luqman Rafiq, or you could search Scriber Academy and you will get it. Now, the third thing is basically IFRS 3 business combinations. Let's have a bit of a discussion about IFRS 3 business combinations. Basically, IFRS 3 business combinations is one of those accounting standards that actually deals with, I repeat, that actually deals with acquisition date accounting. I repeat, it actually deals with acquisition date accounting. Now, what exactly do you mean by acquisition date accounting? Let me just guide you a bit. The concept of acquisition date accounting is the acquisition date is the date when you have actually achieved the control. The date when the control is achieved, that is going to be considered as your acquisition date. So, for any specific subsidiary, I repeat, for any specific subsidiary, the IFRS 3 is only applicable. IFRS 3 is only applicable on the date you acquire control of that subsidiary. I repeat, IFRS 3 is only applicable on the date you acquire control of that subsidiary. So like for example, generally speaking, what happens is that we have a 50%, more than 50% stake that is generally assumed to be having a control. I will discuss more about the control definition as we move on to IFRS 10. But just to give you an idea, if we have more than 50% shareholding of a company, we think that there is a control, right? So the date you achieve the control of the entity, on that date IFRS 3 business combinations will be applicable. That is the only date that IFRS 3 is applied to a subsidiary. Rest of the life IFRS 3 is not applicable. Now, what do you mean by that? Okay, let me just guide you. Basically, I said acquisition date is the date when control is achieved. So as soon as the acquisition date, the control is achieved, what happens is that in accordance with IFRS 3, you have to apply the fair value . You have to apply fair value accounting. What do you mean by applying the fair value accounting? That is basically all the assets and liabilities of subsidiary are measured to fair value. So basically what happens is that all the assets and all the liabilities of the subsidiary are measured to fair value when you apply the fair value accounting. So basically at the acquisition date, IFRS 3 actually guides you what a fair value accounting is going to be. You get my point? IFRS 3 actually guides you what a fair value accounting is going to be. That's what IFRS 3 actually guides us. Now let's move a bit forward and let's have a bit of a discussion further. What is the next thing? So in accordance with IFRS 3, one of the things that we have is we actually are being told that you have to perform the acquisition date accounting. And I told you what an acquisition date accounting is. So with respect to the acquisition date accounting, the acquisition date accounting is basically all the assets, all the liabilities of the subsidiary are to be remeasured to fair value at the date when you acquire the subsidiary. The second thing that IFRS 3 actually guides you about is that IFRS 3 actually, the second thing that the IFRS 3 actually guides you about is the goodwill calculation. Now what exactly do you mean by the goodwill calculation? Let me just guide you. As you know, the goodwill is amount paid over and above fair value. So in accordance with IFRS 3, what we do is that we actually calculate two types of goodwill. We have got one which is called full goodwill and we have got one which is called partial goodwill. So we have got full goodwill, we have got partial goodwill, that is what we do, right? So we either calculate the full goodwill or we either calculate the partial goodwill. That is something that we actually do. Now let's just move a bit forward and discuss a bit further. Okay, now let's move. So basically what a full goodwill is, what a partial goodwill is. The full goodwill is basically when you calculate the goodwill belonging to both parent plus NCI, and the partial goodwill is basically when you only calculate goodwill belonging to the parent entity. So IFRS 3 actually allows you that you can measure full goodwill. IFRS 3 allows you can measure partial goodwill. But again, you got to make sure that if you measure goodwill of one subsidiary, if you apply the full goodwill method to one subsidiary, that means all the subsidiaries have to be the goodwill for all the subsidiaries have to be calculated using the full goodwill method. If you apply partial goodwill method, then that actually means that the goodwill of all the subsidiaries should be measured using the partial goodwill method. You just cannot apply it selectively, that 3 subsidiaries using full goodwill method, 3 subsidiaries using partial goodwill method. You just cannot do the partial application. It has to be complete application. That's what IFRS 3 guides you. Now one more important thing with respect to IFRS 3 is that, which you should understand. All okay? So the one more thing that you need to understand with respect to IFRS 3 is that basically this goodwill is connected to the measurement of non-controlling interest. So in accordance with the IFRS 3, the non-controlling interest could be measured using 2 methods. What are the 2 methods that the non-controlling interest could be measured at? Number one of them is the NCI could be measured at fair value. I repeat, the NCI could be measured at fair value. And what's the other method? The other method is that the NCI could be measured at proportionate share of net assets. The NCI could be measured at proportionate share of net assets, right? The NCI could be measured at proportionate share of net assets. ये zoom पे lag कर रहा है. Right? Okay. Now let's move a bit forward and let's discuss further. So again, as I said that with respect to full goodwill and partial goodwill, if you are measuring the goodwill of one subsidiary using full goodwill method, then all of the subsidiaries goodwill has to be measured using full goodwill method. If you are measuring goodwill of one subsidiary using the partial goodwill method, then the goodwill of all subsidiaries to be measured using the partial goodwill method. And as I said that basically this goodwill and the NCI has got a connection. So whenever there is a full goodwill, the NCI is at fair value. Whenever there is a partial goodwill, the NCI is at proportionate share. So basically there has to be a consistency with respect to NCI measurement also. If you want to measure NCI of one subsidiary at fair value, then NCI of all subsidiaries have to be measured at fair value. If you want to measure NCI of one subsidiary at proportionate share, then NCI of all subsidiaries have to be measured at proportionate share. I'm going to come on to that also, that how do we measure this NCI at fair value and NCI at proportionate share. But before that, the last thing is about the consolidated retained earning. And in general, what happens is that when we talk about the consolidated retained earning, what we generally do is that we generally say that we need parents' retained earnings, so basically it's the parents' retained earning, then you have got any adjustment, you do that, and then you add the share of subsidiaries post acquisition profits. That's how you do the consolidated retained earning. Now before I proceed further on to IFRS 10, there is something that I want to actually discuss with respect to this, and that is basically about this business combination and the goodwill calculation and all that. So if I talk about the goodwill calculation, generally speaking, the method that we follow with respect to goodwill calculation is that we say cost of investment. what do? We say cost of investment. And then in it, what we do is that we say non-controlling interest. Now, irrespective of whether you have got NCI at fair value or you have got NCI at proportionate share, you would just write down non-controlling interest. And then what would happen is that you would say less fair value, less fair value of identifiable net assets. Now when we talk about the fair value of identifiable net assets, this actually would mean what? Subsidiaries share capital, share premium, the retained earnings, any other reserves, and then what happens is that if there are any fair value adjustments, that also actually need to be incorporated. And once you're going to do it, what would actually happen is that you would deduct it here. And when you're going to deduct it here, you will actually end up calculating the goodwill at acquisition. Now there is one very important thing which I want you to understand, which is when we talk about the goodwill calculation, I repeat, when we talk about the goodwill calculation, just remember goodwill is being calculated using IFRS 3. What is it being done? It's being calculated using IFRS 3. Now if it's being calculated using IFRS 3, so what do you mean by this? यहाँ तक ले आओ बेटा कहीं से extension, यहाँ से लगा लो पीछे से. Now when we say, so basically what happens is that the goodwill, when it is being calculated using the IFRS 3, so what actually happens? What actually happens is that it's at the acquisition date. It's actually at the acquisition date. Means everything, the non-controlling interest value, the fair value of identifiable net asset, every single thing has to be acquisition date. It has to be acquisition date. The date when you achieve the control, that's what is the date that has to be used. Now, with respect to fair value adjustments, the fair value adjustments could be the fair value adjustments with respect to assets. It could be the fair value adjustments with respect to liability. It could be all fair value adjustments. Right? It could be the fair value adjustments with respect to assets. It could be the fair value adjustments with respect to liabilities. So all the fair value adjustments actually need to be considered. I repeat, all the fair value adjustments actually need to be considered. ये जो ना इसमें इसका वो लेकर आओ, एक और होल्डर लेकर आओ, ये इस पे चल नहीं रहा 3 पिन का. Okay, so basically what have we done? We've said goodwill, cost of investment, non-controlling interest, fair value of identifiable net assets, things like that. Now you end up getting what? Goodwill at acquisition date. Now one more thing that actually comes into mind is that how exactly do we have different type of measurements of NCI. So when we have got different type of measurements of NCI, the different type of measurements of NCI actually is like this. The NCI could be measured at fair value. The NCI could be measured at proportionate share. Now what exactly do you mean by the NCI being measured at fair value? What exactly do you mean by NCI being measured at proportionate share? Try to understand. When we talk about the NCI at fair value, the NCI at fair value actually means what? You would say number of shares owned by NCI multiplied by market value of each share. Number of shares owned by NCI multiplied by market value of each share. And when we talk about the NCI at proportionate share, so NCI at proportionate share is like this: fair value of net assets of subsidiary multiplied by percentage owned by NCI. Means like what happens is that, for example, if you have got 50,000 shares of the subsidiary and the market value of each share is $2.5, so that means 112,500 is going to be the fair value of NCI. Similarly, if I move a bit forward and if I say NCI at proportionate share, how exactly do we have the NCI at proportionate share? You would have the fair value of net assets. You would have the fair value of net assets of the subsidiary. So let's say if the fair value of the net assets of the subsidiary are 200,000 and NCI owns 30% of it. So if the NCI owns 30% of it, resultingly 60,000 is going to be considered as an NCI. Resultingly 60,000 is going to be considered as NCI. So under the full goodwill and the partial goodwill method, the only difference is basically going to be this NCI. If NCI is at fair value, then the goodwill that you end up getting is full. If the NCI is on proportionate method, the goodwill that you end up getting is partial. The goodwill that you end up getting is partial. You get my point? Now, there is one more important thing with respect to this IFRS 3 and that I actually want to discuss before I move further, and that is basically the concept of measurement period change. Now what exactly do you mean by this measurement period change? Let me just guide you a bit. Basically what happens is that when you actually have to acquire a subsidiary, let's say you have a year end of 31st December and you acquired the subsidiary on, let's say, 1st November is your acquisition date. This 31st December is your year end. You've got a 31st December year end and you've got the 1st November, which is the acquisition date. Okay, Arslan Tariq, yes, I'm just going to come on to it. Okay, let's say if you've got 1st November acquisition date and you've got a 31st December year end, just try to understand what's going to happen. Now the problem is that my year end is 31st December and I have to prepare consolidated financial statement. Now if my year end is 31st December and if I have to prepare consolidated financial statement, how exactly am I going to do this consolidation? For this consolidation, one very important thing that needs to be completed is the fair value accounting. I repeat, one very important thing that should have been completed is fair value accounting. Now when we talk about one very important thing, fair value accounting, that means fair value accounting is not a joke. It's a time taking process. At times you got to involve valuers, you have to have several actuaries, you have to apply different estimation techniques. There are many things that actually need to be done with respect to, I repeat, there are many things that actually need to be done with respect to this fair value accounting. It's not a simple task. So maybe what happens is that the year end is arrived and you have still not been able to do the fair value accounting. So what would you do? You would have your best estimates of fair value, and you would calculate the goodwill on that basis. You will have your best estimates of fair value, and you would have actually calculated the goodwill on that basis. Now just try to understand something. Basically, now basically what happens is that, try to see. Let's say the cost of investment was 500,000. You acquired subsidiary 100%. So the fair value of net assets was assumed to be 420,000. You had a goodwill of 80,000. What did you have? You had a goodwill of 80,000. Now what's going to happen? Try to see. Basically, you prepared the consolidated financial statement at year end, the year end passed, everything happened smoothly, and then things went by. Now what happens is that by 31st of May next year, let's say 2024, you receive a report from the valuer, and he says that the acquisition date fair value of net assets was not 420,000, but it was rather 445,000. So what are you actually going to do as an entity? Because you estimated the fair value to be 420,000, you calculated the goodwill on that basis, you performed the calculations, and now you have moved forward. So IFRS 3 says that basically there is a concept which is called measurement period change. What is it? It's called measurement period change. What do we mean by measurement period change? Try to understand the measurement period change. The concept of measurement period change is what? The concept of measurement period change is that an entity has 12 months period from date of acquisition to complete acquisition accounting. So what does it say? It says an entity has 12 months period from the date of acquisition to complete the acquisition date accounting. That means that from the date you acquired, which in this case is 1st November, till 31st October next year, you have time that you can complete acquisition accounting. And in case, if you think that the original value was something else and it turned out to be something else when you completed the valuation, you are allowed to go back and change the previous calculations as if you had always had an idea that this was the value. Now this is an area that the examiner at times does examine, which is he talks about this measurement period change concept. So whenever the examiner examines you this measurement period change concept, always remember, what do you need to do? You need to make sure that you understand that if within the 12 months period of the acquisition, if there is a change, then what you need to do is that you need to incorporate that change in the financial statements, and you have to think as if it was always the case, right? So that means the goodwill is going to be restated. That means the net assets are going to be restated. That means all the depreciation, etc., pertaining to this acquisition has to be restated. That's what you will have to do. Now, let's move a bit forward. There is this one last area which is basically about the concept of impairment of goodwill, and I want to discuss this impairment of goodwill with you people. That how exactly are we going to talk about the impairment of goodwill? So basically, when we talk about the impairment of goodwill, always remember there are two ways of recognizing the impairment. It depends upon whether you have got a full goodwill or whether you have got a partial goodwill. Now what actually happens with respect to full goodwill and what actually happens with respect to partial goodwill, let me just guide you a bit. For example, you have got %80 subsidiary. Now what happens is that the carrying amount of net assets is 400,000. The goodwill is 50,000. And you are being told that the recoverable amount of the subsidiary is 460,000. So what is going to happen in this scenario? You would say that there is no impairment loss. Why? Because in accordance with the IFRS, what actually happens is that when does the impairment loss arise? The impairment loss actually arises whenever the carrying amount is greater than recoverable amount. So I repeat, whenever you've got a carrying amount which is greater than recoverable amount, that's when the impairment actually arises. So if the carrying amount is greater than recoverable amount, that means the impairment has arisen. But here the recoverable amount was higher, 460,000. The carrying amount was 450. That means there is no impairment. Now, if this would have been the same case and had we had the partial goodwill, so what would have happened? You would say carrying amount of net assets 400,000. You would say the goodwill. This 50,000 goodwill is for the 80% business, because when you have got a partial goodwill, the partial goodwill is the goodwill for 80% of the business. 50,000 divided by 0.8, so you end up getting 62,500 as a goodwill. Now what actually happens is that your carrying amount becomes 462,500. I bet your carrying amount becomes 462,500. So if your carrying amount becomes 462,500, you would say the recoverable amount is 460,000. That means 2,500 is the impairment. So I repeat, that means 2,500 is the impairment. You get my point? That means 2,500 is going to be the impairment, right? Now, basically, what have I done? I've simply said that, look, this whole value, the 460,000 was for the whole business. But the goodwill of 50,000 was a partial goodwill. That means it was pertaining to 80% interest only. So this 62,500 is also called as, notional goodwill. I repeat, this is also termed as notional goodwill. What is it termed as? Notional goodwill. So it's notional goodwill, grossed up goodwill, that's what it is going to be. Now see, since we have only recognized, I repeat, since we have only recognized 80% of the goodwill, therefore out of this impairment loss, only 80% of the impairment loss is going to be recognized. So if I say the impairment loss to be recognized, it's going to be 2,500 into 80%. So this is actually going to be 2,000. So if I say the impairment loss that needs to be recognized, it is actually going to be what? 2500 into 80%, which is 2000. That's what the impairment loss that's going to be recognized. You get my point? So this is something which is important with respect to IFRS. Now let's move a bit forward and let's move on to the next accounting standard, which is the IFRS 10 consolidated financial statement. Now what exactly do you mean by this IFRS 10 consolidated financial statement? Let me just guide you. Basically, when we did the acquisition date accounting, the acquisition date accounting was done in accordance with IFRS 3 business combination. The acquisition date accounting was done using IFRS 3 business combination. Now, when we go about consolidating the financial statement, so consolidation is done in accordance with IFRS 10. Now, what do we mean by consolidated financial statement? As you know, the consolidation actually means to add up. The consolidation actually means to add up. Add up means asset plus liabilities. Now, when we talk about the consolidated financial statement, what actually happens is that if you have got, let's say, if you have got parent and subsidiary. So what you do is that with respect to SOFP, with respect to SOCI, we add up these results. We add up these results. And when it comes to the group SOFP, a single line item is shown. When it comes to the group SOCI, a single line item is shown. So when we talk about the concept of consolidation, the consolidation means to add up. The consolidated means to add up. And the consolidation is done in accordance with IFRS 10. Now a very important thing. A lot of people, they get confused with respect to that what is a subsidiary and what is not subsidiary. For example, if I say that I own 60% of a company's shares, you would say that that means you have a control over that company. But I would say no, it depends. Because the control, to have control, you should meet the definition of control under IFRS 10. Now what exactly is the definition of control under IFRS 10? We are going to talk about it. In accordance with IFRS 10, an entity is said to have control over investee. I repeat, an entity is said to have control over investee when all these three conditions are met. Now what are these three conditions that have to be met? The number one of them is power over investee. Number two is exposure or rights to variable returns over investee. And number three is ability to use the power to influence the returns. Now let me just guide you. What do you mean by concept of power? See, the power is basically to influence the decisions. The power is actually to decide on behalf of this investee, to decide about their business, to decide about their main business, to decide about their main activities. That's what is considered to be having a power. So for example, if I am saying that I have got power over XYZ entity, that means my power would allow me that I can ask that entity to shut down a factory, to open a factory, to shut down a geographical location, to set up a factory at a new geographical location, etc., etc., to discontinue a product, to launch a product. That means I can take those decisions which could actually have an impact upon the entity's returns. So that means I've got the power over investee. That's one thing. So you only classify an investment as a subsidiary if you have control over them, and the control is when all three conditions are met, which is number one, you should have the power over investee. And I'm telling you, power is basically when you can decide on their behalf. The exposure or rights to variable returns over investee. The investments that I have made, like we make investments in bank, we make investments in different companies' shares. So at times when we make investments in bank, we are not exposed to the returns of the bank. We say that even if the bank runs into losses, we still be needing 10%, 12%, 8%, 7% return. Why? Because that's what an agreed return is. So that means you are not exposed to variable returns. You are not exposed to variable returns. So if you are in a situation, which is generally in the case of an investment in a company, where if the investee does not earn good money, you don't get good money. Where the investee earns good money, you get good money. So you have got exposure and you have got rights to variable returns of the investee. The third thing is that ability to use the power to affect returns of the investee. Now that's a very important decision. Now, a lot of you people have an idea about the companies getting into administration. A lot of you people have an idea about the companies getting into administration. So when I talk about a company getting into administration, that's when a company is struggling to meet its finances. So in order to make sure that this company is able to survive, the company may apply for administrations. The administration, entering into administration actually avoids bankruptcy. Because when you enter into administration, that means you have actually engaged people, you've actually engaged the government to deploy some experts who could manage the business, who could bail out the business from this current position. Now, let's say I've got majority representation on the board of directors and I am saying that I've got power. Okay. But right now the company has entered into administration. So if the company has entered into administration, I'm not allowed to make any decision on my own. I need to follow the administrator. I need to follow the directions of administrator. Every single decision has to be taken by the administrator. So despite having majority representation on the BOD, despite having majority power, you would still not be able to exercise your power. And when you're not able to exercise the power, that means when you're not able to exercise the power, that means you don't have control over investee. Because the controls definition means that all these three conditions have to be met. If any of the condition is not met, you don't exercise control. You get my point? So basically, that's a very important definition with respect to IFRS 10, which is the definition of control. That who is the subsidiary, an entity which is subject to control. And when we talk about control, what does control mean? The control mean all these three conditions have to be met. Even if one single condition is not met, you don't have control. Next, there is another concept which is called potential voting rights. Let me just guide you people a bit that what exactly do you mean by these potential voting rights. Let's just see. See, for example, I right now have 35% shares in a subsidiary, but I have got option to buy additional 30% shares. Now see, if I'm gonna buy the additional 35% shares, additional 30% shares, I'll be standing at 65%. And under the normal circumstances, this 65% is gonna give me control. So that means if I exercise those options, I'm gonna get control. So should we consider these options right now or should we wait for some time? So what does IFRS says? IFRS says that, look, what you need to make sure is that you need to see if these potential voting rights are substantive or not. What do you mean by substantive? When we talk about the concept of these rights to be substantive, so this rights being substantive actually means that are they likely to be exercised? Are they likely to be exercised? Now, when are they likely to be exercised? Let me just give you a bit of an idea. See, I have got options on a company and that company is my supplier. I know if I am actually gonna exercise these options, my supply is gonna become secure. And this supplier actually has got access to some cheaper materials, so I can get cheaper supplies. So what am I likely gonna do? I'm probably gonna acquire the majority stake of that supplier so that I control the supplier, I control my supply chain, so that nobody else could affect my supply chain and I'll be operating at good economies of scale. When I would operate at good economies of scale, that means I would be earning good profits, good returns. It's a lucrative opportunity for me to acquire these 30% shares. So if it's a lucrative opportunity for me to acquire these 30% shares, that means the rights are highly likely going to be exercised. And therefore the rights or these potential voting rights are substantive. Now, if potential voting rights are substantive, then what you need to do is that you need to understand that your subsidiary, then your subsidiary is actually going to be what? You have this 35% shares plus 30%, you have got potential voting rights. So this is going to be considered as your subsidiary. Although you have not exercised these potential voting rights now, but these potential voting rights are substantive and they are highly likely going to be exercised at any cost. So resultingly, this is going to be what? Resultingly, this is going to be a case where you would say that this entity where you have got 35% holding plus 30% rights becomes your subsidiary. 35% holding plus 30% right, it actually becomes your subsidiary. You get my point? So that's important thing with respect to IFRS 10. Now if I move a bit forward and if I discuss further, the next thing with respect to IFRS 10 is that when we talk about the consolidation, there are few things that you actually have to understand, which is all intragroup transactions have to be eliminated. What do we mean by all intragroup transactions have to be eliminated? Just try to understand this. When we talk about all intragroup transactions have to be eliminated, that means that whatever the sale transaction, whatever the purchase transaction, whether that be about the inventory, whether that be about the non-current asset, etc., that has to be eliminated. Number 3, whatever the loans, whatever the receivable, whatever the payable, whether that be pertaining to loan, whether that be pertaining to interest, etc., that needs to be eliminated. Whatever the loans, interest, dividends, etc., this all has to be eliminated, right? This all has to be eliminated. So always remember, with respect to consolidation, that's what we do. With respect to consolidated SOFP, there are few important rules, which is basically the all assets and liabilities are added. The second thing is that investment is replaced with goodwill. The third thing is that only parents share capital and share premium is shown. So you only have parents share capital and share premium is shown. And the fourth one of them is NCI shown at the end of equity. The NCI is shown at the end of equity. Now what exactly do you mean by NCI being shown at the end of equity? Let's try to understand. So basically you write down the entire equity, like you've got capital, you've got premium, retained earning, etc., etc. Then you write down NCI. What do? You write down NCI. With respect to the consolidated SOCI, what are the things that you have to keep in mind with respect to consolidated statement of comprehensive income? That is basically only post acquisition, only post acquisition only post acquisition results of subsidiary are added. The intragroup sale and purchase deducted from sale and cost of goods sold. Any unrealized profit is added to cost of goods sold. Any unrealized profit is added to cost of goods sold. So what you need to do, you need to understand that any unrealized profit, it's added to cost of goods sold. So repeat, any unrealized profit is added to cost of goods sold. Okay, Arslan, you were asking a question that how do we value these potential voting rights? We don't do anything. Just the investment that we have made, we consider that. And these potential voting rights are just, like you calculate the goodwill on the basis of 35% ownership. But what happens is that you calculate goodwill. That's important. Why? Because you have got potential voting rights, and because of potential voting right, it becomes your subsidiary. You see, because of these potential voting right, it becomes your subsidiary. That's what you do. You get my point? So because of your potential voting right, this becomes your subsidiary. That's important. But how do we calculate? You don't have to calculate the potential voting rights in the cost of investment. You don't have to do that. Okay, then there is this final accounting standard with respect to the consolidation, the group accounts, and that's actually about the IFRS 11, which is the joint arrangements. Now, let me just guide you people a bit that what is this IFRS 11 joint arrangements all about doing, all about. So when we talk about the IFRS 11 joint arrangements, the IFRS 11 actually talks about three different types of joint arrangements. One of them is jointly controlled asset, the other one of them is jointly controlled operation, and the third one of them is jointly controlled entity. Now what exactly is the difference between this jointly controlled asset, jointly controlled operations, jointly controlled entity? Try to understand this. When we talk about the jointly controlled asset, the concept of jointly controlled asset is that, for example, Mr. A and Mr. B, one of the persons have invested 40% in an asset one of the person has invested 60% in an asset. I mean, one of the person has invested 40% and the other person has invested 60%. So if you own an asset, it could be anything, it could be a vehicle, it could be a property, it could be anything. That is called jointly controlled asset. What is it termed as? Jointly controlled asset. Now, when we talk about the jointly controlled asset, how do you account for it? In your statement of financial position, you would record own share of asset. Let's say if you own 40%, and the asset was worth $1 million. So 40% into 1 million would actually give you 400,000. 40% into 1 million is going to give you $400,000. Then the second one of them is called jointly controlled operation. What do you mean by jointly controlled operation? Jointly controlled operation actually means a situation where what happens is that you've got a full-fledged sale, purchase, everything going on, like full-fledged operations. Maybe let's say construction of a building, construction of a road, or construction of a dam, construction of a tower, bridge, etc. 2 or 3 or 4 or 5 people, they are combined dealing with that specific project. So that is going to be termed as jointly controlled operation. And when you have jointly controlled operation, how do you account for it? You actually recognize each person has to recognize their share of asset, liability, income, expense. So each and every person has to recognize their share of asset, liability, income and expense. Now what do we mean by this? For example, you would prepare your P&L, you would prepare sales, you would prepare the expenses, etc. You would prepare the balance sheet, assets, you would prepare the balance sheet, you would say liabilities, etc., etc. So whatever the amount is, you multiply by 25% if it belongs to you. See, you get my point. Should actually recognize your share of sale, your share of expenses, your share of assets, your share of liabilities. That's what you're going to recognize. You get my point? Now, lastly, we've got a jointly controlled entity. What do I mean by jointly controlled entity? Try to understand. The jointly controlled entity is similar to jointly controlled operation. There is only a very small difference, minor difference. What is that minor difference? Try to understand this. The minor difference with respect to the jointly controlled operation and jointly controlled entity is that over here under the jointly controlled entity there is a separate legal entity. Under the jointly controlled entity there is a separate legal entity. What is it? It's a separate legal entity that's created. So this jointly controlled entity is actually termed as, this jointly controlled entity is also termed as joint venture. And when I talk about the joint venture is accounted for using IAS 28. The joint venture is accounted for using IAS 28. So how do we account for the joint venture? The joint venture is accounted for using IAS 28, which we have already discussed, which is the investment in associates and investment in joint ventures. So basically, in short, this is the entire conclusion of the consolidation, the group accounts related area, and I mean that's what it is. But there are many more things. I'm gonna go on to them. But for the time being, if any one of you has got any questions up till now, you may ask, or else I'm gonna move forward. I'm sorry if there is a bit of a lag in the video. We just tried to make sure that we deliver a good quality video to you. Okay. What about foreign entity and cash flows? Oh yes, Sanaullah, I'll just come on to them. Just wait a bit. Because IS 21 is where you go about with the foreign subsidiaries. Impairment with respect to associate. Okay, Kaisar, let me just discuss what will be the treatment of share options leading to dilution of control. Will that be considered discontinuation of? Okay. Yes, that's how it is going to be, Mir Fias. Now this is how this is going to be. Okay. So this is in general the accounting standards that are applicable with respect to the group accounts. Now what I'm actually going to do is that I'm going to talk about more areas pertaining to the group accounts so that we could have a complete revision of group accounts actually. Now basically one of the situations that is usually examined with respect to the group accounts is the scenario where you are being asked for the step acquisition. There's a concept of a step acquisition. What do I mean by step acquisition? There could be multiple types of step acquisition, but generally the concept of a step acquisition is when you acquire a subsidiary in steps. When you acquire a subsidiary in stages, like some acquisition is done now, some a bit later, then a bit later, then a bit later. So that's actually called the step acquisition. Now, when we talk about the step acquisition, it could be you have a 20% shareholding and you go on to 60%. You might then go on to 90%. You have a 20% shareholding, you might go to 45%, then 70%, then 80%. Any specific scenario could prevail. So what is actually this is all about, this is simply the concept of step acquisition where you acquire a subsidiary in steps, you acquire a subsidiary in stages. Now when we acquire a subsidiary in steps, when we acquire a subsidiary in stages, how do we go about it? We go about it like this. We usually classify them into two categories, whereas one of the acquisition where control is achieved, and there is another scenario whereas the control already exists. So there is one situation where the control is achieved, and there is another situation where the control already exists. So like for example, here you are actually achieving control. Here the control exists. Here the control exists. So we're going to talk about both the situations, that how are we going to deal with these two-step acquisition scenarios. The first scenario is you had a 25% shareholding and you have increased your shareholding to 70%. So how exactly are we going to account for such type of scenario? Let's try to understand. As per the IFRS, the existing interest should be remeasured to fair value. Any gain or any loss that arises should be taken to P&L. Goodwill shall include cost of investment as follows. How? When you're going to talk about the cost of investment, you would say fair value of existing interest cost of further acquisition. So like for example, just try to see this. You had a 25% shareholding in a subsidiary. Try to see. You had a 25% shareholding in a subsidiary, and the book value of that 25% was, let's say, 20 million. And the market value right now is 33 million. The additional shareholding, how much is the additional shareholding? The 45% additional shareholding that you acquired that for 70 million. So what are you simply going to do? You're simply going to say the cost of investment is going to be what? The cost of investment is going to be the fair value of existing investment, which is 33. Cost of further acquisition gives you 103 million. Gives you 103 million. What is it? 33 million, the fair value of existing interest, plus cost of further acquisition, which is 70 million, gives you 103 million. What does it give you? It gives you 103 million. Right? So the rest you people know, that basically the important thing is cost of investment, then the NCI is there, the fair value of net assets is there, etc., etc. Now what actually happens is that when you acquired this subsidiary, the existing interest was remeasured to fair value. There is a gain of 13 million. This 13 million gain has to be taken to P&L. This 13 million gain has to be taken to P&L. I bet this 13 million gain has to be taken to P&L. Now, for SOFP and for SOCI, 100% assets and liability is consolidated. But for SOCI, what are you actually going to do with respect to SOCI? So with respect to SOCI, you would have to make sure that what you do is that only consolidate for the period when control existed. So like if for the whole of the year, let's say for 10 months of the year, I repeat, let's say for 10 months of the year you had 25% shareholding. For the last 2 months it has become your subsidiary. So you would only consolidate the last 2 months in the P&L. But obviously for the balance sheet, since it is as at a specific date, so you consolidate the balance sheet 100%. But for the P&L, you only consolidate 2 months results. Now let's move a bit forward and let's discuss further. The next situation is basically scenario 2, where you now had 60% shareholding and you have increased your shareholding to 85%. That means it was already a subsidiary, but now you have enhanced your shareholding from 60% to 85%. So what's actually going to happen is that there is a 25% increase in your shareholding. What is there? There is a 25% increase in your shareholding. So if there is 25% increase in your shareholding, how exactly are you going to account for that? As per the IFRS, a gain/loss is to be calculated. And you have to recognize this within equity. You have to recognize this within equity. What do I mean by this? Recognize within equity. Let's try to understand things. Basically what happens is that, let's say that $25 share was purchased for 20 million. The carrying amount of NCI was $28 million. Now how exactly are you going to do the calculation? Try to understand. You would simply say the consideration paid, which is 20 million, then you would say NCI acquired. Now what is the NCI that is acquired? 28 multiplied by 25% divided by 40%, because the NCI was 40% here and it has become 15% here. So when you have enhanced your shareholding, what have you done? You have actually acquired NCI. So this basically 28 million NCI, I repeat, this 28 million NCI was 40%, and you have acquired 25% out of it. So what was the worth of that 25%? 28 divided by 0.4 multiplied by 0.25 gives you 17.5. So there is a loss of 2.5 million. What is it? It's a loss of 2.5 million that has actually arisen. Now how exactly are you going to account for it? Try to understand this. You're going to account for it like this, because you would have originally recorded in the separate financial statement you would have said investment debit, cash credit by 20 and 20. But when it comes to the group account, what are you simply going to do? You're going to say investment is credited by 20. You would remove 20 from the investment. And you would say NCI debited by 17.5, because you would actually be removing 17.5 from the NCI. I bet you would actually be removing 17.5 from the NCI. You would actually be removing 17.5 from the NCI. Similarly, you just cannot recognize this loss of 2.5 million in P&L. So what are you actually going to do is that you're going to say retained earning or any other head of equity divided by 2.5, because it has to be recognized within equity. You could recognize it in other reserve you want, you can recognize in retained earnings, whatsoever you want to do, you can go about that way. So that's basically, whenever you have got a step acquisition, this is how you are actually going to do. Just wait a bit, I'll just answer the queries. I know you people cannot wait for me to go to IS 21. I'll cover the foreign subsidiary here also. Now, there is another aspect that I want you to understand, and that's basically the concept of group disposals. When we talk about the group disposals, there could be two types of situations. What are the two types of situations? One of them is basically control lost. The second one of them is control retained. The first one of them is control lost. The other one of them is control retained. Now, what do you mean by control lost? What do you mean by control retained? Just try to understand this. The concept of control lost is going to be like this. You had a 80% shareholding. It becomes 25%. That's control lost. You had a 80% shareholding. You dispose of some portion. You still stand at 65%. That's control retained. So what is going to be the accounting treatment here? Here what happens is that you would say stop consolidating. That's number one. You would say stop consolidating. The second thing is that recognize fair value of retained interest. What do you mean by retained interest? This 25% that you have after the end of this disposal, that's retained interest. That's retained interest. The third thing that you do is that, you basically de-recognize. What do you do? You de-recognize. You de-recognize goodwill, net assets, NCI. Lastly, what happens is that any gains, any loss are actually recognized in P&L. I repeat, any gains, any loss are actually recognized in P&L. So any gains, any loss, they are actually recognized in P&L. Right? Now let's move a bit forward, let's discuss further. I'm going to do a sample calculation for you people also, but now let's talk about the situation where the control is retained. What happens with respect to control retained is that you calculate gain or loss on disposal. What do? You calculate the gain or loss on disposal. And then the next thing that you do is that you recognize such gain or loss within equity. I bet you recognize such gain or loss within equity. What do? You recognize such gain or loss within equity. That's what you do. Now let's try to understand this more. How exactly are we going to do it? Let's say, for example, if you have disposed of a subsidiary and if you have lost control, so the gain or loss on disposal is going to be like this. Disposal proceeds. Then you would see add fair value of retained interest and then you deduct what? Goodwill, net assets, so there is actually a gain or loss on disposal. There is a gain or loss on disposal. How do you recognize that gain or loss on disposal? You recognize the gain or loss on disposal like this. You have a disposal proceeds. Let's say for example, if I give you an example, let's say you had a 80% subsidiary, you disposed of and you are now standing at 10%. Let's say the disposal proceeds are 200 million. The 10% holding that you retain, it has a fair value of 15 million. The goodwill was 25 million, the net assets were 150 million, the NCI was 40 million. So resultingly what happens is that the sum of all these was 135. So basically 200 plus 15 minus 135 gives you 80 million as the gain. Gives you 80 million as the gain. Now how exactly are you going to recognize this gain? Try to understand. I'll show you the accounting journal for this because at times from the perspective of exam, you may actually have this accounting journal being examined for you. Now what is going to be the accounting journal for it? Try to see. The accounting journal for it is going to be, you would say, cash debit by 200, the investment debit by 15, NCI divided by 40. Goodwill credited by 25. Net assets credited by 150. And the P&L is going to be credited by 80. Right, the P&L is going to be credited by 80. Just a second, please. Just a second. Hello? Okay, now let's move a bit forward and let's discuss further. Okay, if there is a loss on disposal, the P&L would be debited. The P&L would be debited simply because the loss is, with the loss you debit the profit and loss account. Now let's move a bit forward and talk about the second situation where you have got the control which is retained. Let's talk about the second situation where the control is retained. Where the control is retained. Now let's try to understand this, that what is going to happen with respect to control is retained. So I told you people that you have to calculate the gain or loss on this disposal and it has to be recognized within the equity. You don't have to take into P&L. Like you had a 80% shareholding and now you disposed of, let's say, and it has now become 70%. You had a 80% shareholding and now it has become 70%. So what's actually going to happen? What are you going to do? You're simply going to do it like this. You would say, disposal proceeds, and then you would say less the net assets disposed of. Now how would you actually say the net assets disposed of? Try to understand this. You would say net assets you would say goodwill, now I'll create a loss making situation over here because you are asking for a loss making situation, right? So let's say you disposed of this 10% shareholding and you disposed it off for $20 million. The net assets of the subsidiary were $300 million. The goodwill was $20 million. That means it was a total of 320 million and you disposed of 10% of it. So that means when you dispose of 10% of it, 32 million is going to be the net assets disposed. So resultingly 12 million is going to be the loss. Resultingly 12 million is going to be the loss. I bet 12 million is going to be the loss. Right? How exactly are you going to recognize it? Try to see this. How exactly are you going to account for this? You would say cash debit 20, equity debit by 12, NCI credit by 32. Why? Because when you are disposing of, whose interest is increasing? It's the non-controlling interest whose interest is increasing. You get my point? When you are disposing of, whose interest is increasing? It's the non-controlling interest whose interest is increasing. You get my point? So that's what you are going to do. So we have now discussed the step acquisition. We have now discussed the group disposal. Okay, so I'm just going to move forward a bit. Just allow me a minute and then I'm going to move forward. Just allow me a minute. I'm going to move forward then.
अस्सलामुअलैकुम कैसे सर ये बताएं क्या क्यों चाहिए सेम ऐसे एक्सपीरियंस हो क्यों चलेगा तो बंदा 2300
Okay guys, so we have discussed about this area, which was the step acquisition and the group disposal also. Now, a lot of you people were actually inquiring about the foreign subsidiary, so I'll just go about discussing about the foreign subsidiary, and then what I would do is that I would open up the floor for all of you to actually start asking whatever questions that you have, and I will just keep on answering those questions, so that we could just go on and discuss things, right? Now, so see, let's talk about the foreign subsidiary. Now, what exactly do you mean by the foreign subsidiary? So, you know this thing that when you have a investment in some foreign country, so you have got a different currency to operate. So there is an IS 21 where we actually have got 3 different type of currencies that are available. One of them is called functional currency. The other one of them is called foreign currency, and the third one of them is termed as presentation currency. So what is the functional currency? The functional currency is generally the currency of the primary economic environment in which an entity operates. So when you talk about the functional currency, the general concept of the functional currency is that let's say if you are based in UAE, then it is most likely that your functional currency is going to be AED. If you are based in UK, it's generally most likely that your functional currency is going to be the GBP. If you are based in USA, it is most likely your functional currency is going to be USD. Like, it's majorly the currency in which you do business, you retain money, you borrow money, you generate profits, you incur costs. Like, the currency that is majorly used in your business, that's called your functional currency. And what we actually do is that we actually, I repeat, just a second please. Okay, so basically what happens is that you've got functional currency, right? What is the functional currency? Currency of the primary economic environment in which an entity operates. It's the currency of the primary economic environment in which an entity operates that is going to be considered as your functional currency. Now, what is the foreign currency? The foreign currency is basically foreign currency is any currency other than functional currency. So like if you are based in UAE, AED was your functional currency. So now every other currency that you are going to transact in, that is going to be a foreign currency, whether that be euro, whether that be GBP, whether that be Kuwaiti dinar, whether that be Bahraini dinar, whether that be Chinese yuan, whatsoever that is going to be your foreign currency. And lastly, presentation currency. What is this presentation currency? The presentation currency is the currency in which financial statements are prepared. The presentation currency is the currency in which financial statements are prepared. That's considered to be presentation currency. Now, let me just guide you people a bit. So as I said, there is a functional currency, there is a foreign currency, there is a presentation currency. There are two things. One of them is books of account, one of them is financial statement. So always remember, the books of accounts are always measured, the books of account are always recorded in functional currency. The books of account are always under the functional currency. What's the what is under the presentation currency? It could be anything. Like you can have multiple presentation currencies also. Let's say you're based in UK, so you're preparing financial statement in GBP. Maybe let's say you are preparing financials for your parent in USD. Maybe you are presenting the financial statement for your ultimate parent in Chinese yuan, etc. Like you could be preparing your financials in multiple currencies. So there could be multiple presentation currencies that you can have as an entity. Now, what's going to happen? Try to see this. Basically, if I'm talking about a foreign subsidiary, so there are few things with respect to foreign subsidiary that you need to understand. One of them is about the goodwill. The second thing is about the consolidated SOFP. The third thing is about consolidated SOCI. And the fourth thing with respect to it is about, the fourth thing is basically is about the exchange gains and losses. I'm going to discuss each one of them, that how exactly do we account for these, what are the differences in this accounting with respect to foreign subsidiary. I'm going to talk about each one of them. First of all, when it comes to the goodwill, so what actually happens is that for the foreign subsidiary, there are few things that you have to do with respect to goodwill, which is calculate in foreign currency. Number two. So the first thing that you have to do is that you have to calculate in foreign currency. Number two is that you have to translate using closing exchange rate at each reporting date. Then what you have to do is that any exchange gain or loss has to be taken to OCI. Now there are few things that you need to understand, which is you have to calculate the goodwill in foreign currency. You have to re-measure or you have to translate the goodwill at each reporting date using closing exchange rate. When we talk about the closing exchange rate, the closing exchange rate actually means the reporting date exchange rate. The closing exchange rate means reporting date exchange rate. And any exchange gains or losses have to be taken to OCI. Try to understand this. Let's say, for example, let's say you're based in, your functional currency is AED. And your foreign investment is in euro. let's say you have been given the exchange rates, which is 3.73, and you have been given the exchange rate as 3.79 at the different year ends, the year 1 and year 2 end. What's going to happen now? Let's say, as I said, that year 1 and year 2 end. So what is actually going to happen is that the goodwill that you had was euro 5,000. Now, at the end of year 2, there are 2-3 things that you would have to do, which is you would see opening goodwill at opening rate. Exchange gain loss, then the closing goodwill at closing rate. Just try to see what's going to happen. You have 5,000 euro, the AED, which is your, let's say, presentation currency, it's 3.73 is the exchange rate at the start of the year. So it's actually going to be 1340 okay, in fact I just rounded off, 1340.5. The exchange gain loss is the balancing figure. The closing goodwill is going to be 5,000 divided by 3.79. It is actually going to be 1319.26. So hence what is going to happen is that there is going to be a 21.24 exchange loss. There is going to be a 21.24 exchange loss. Now try to see something, what's going to happen. You have got a 21.24 exchange loss. So you would simply do it like this. You would say OCI debit, $21.24 and the goodwill credited by 21.24. You've got OCI debit by 21.24, you've got goodwill credit by 21.24. You get my point? Now that's one situation. Now, there is one more thing that you need to understand with respect to it, is that in case of impairment loss, it has to be taken to P&L. So like what could actually happen, try to see. Opening goodwill, let's say, was euro 5,000. Let's say impairment is 5%. Exchange rate, year 1, year 2 end and year 1 end. Average rate for year 2 is, let's say, average rate for year 2 is, let's say, 3.715. Now what is actually going to happen in this scenario? How would you account for this scenario? Let me just guide you a bit. You would simply do it like this. You would say, opening goodwill at opening rate, impairment loss, exchange gain loss, closing goodwill at closing rate. Now what are you simply going to do? You're going to say 5,000 divided by 3.70. So it's actually going to be 1351.3. The impairment loss 5,000 into 5% divided by 3.715, because usually the impairment loss does not happen on one day, it happens over a period of time. So probably at times we use the average rate, 5,000 into 5% divided by 5,000 into 5% divided by 3.715. So it's actually going to be 67.29. The exchange gain loss is going to be the balancing figure. The closing goodwill is going to be 5,000 into 95% divided by 3.74. So it's actually going to be 1270 round figure. Now you would have a balancing figure to be the exchange gains or loss. What is this balancing figure of exchange gain or loss is going to be 1351.3 minus 67.29. So it is going to be 14.01. How are we going to record this accounting entry? We're going to say P&L debit. We're going to say OCI debit. P&L is going to be debited by 67.29 because that's the impairment loss. The OCI is going to be debited by 14.01, and the sum of all this will reduce the carrying amount of goodwill, which is 81.3. It will reduce the carrying amount of the goodwill, which is going to be 81.3. You get my point? Now, so that's one thing with respect to goodwill, and in case if there is an impairment, that's how you do it. Now let's move a bit forward. So basically, when you talk about the consolidated SOFP, so what happens is that all assets and liabilities are translated using closing exchange rate. All assets and liabilities are translated using the closing exchange rates. With respect to consolidated SOCI, all items of income and expenses are to be translated at transaction date exchange rate. But this is practically not possible. So practically what is used is average rate for the period. So practically what happens is that the average rate for the period is used. Now, lastly, we have got one more area, which is the translation reserve, or as you say, it's a translation gain or loss. Now what is this translation reserve or the translation gain or loss? Let's just try to understand. What actually happens is that when we talk about the translation gain or loss or translation reserve, you do it like this. You say opening net assets at opening rate profit for the year at average rate exchange gain or loss closing net assets at closing rate. Now just try to see this. Let's say, for example, you have a subsidiary, a foreign subsidiary, where the opening net assets were, let's say, 20,000 and the opening rate was 4. So like, let's say your currency, it's gonna become $5,000. During the year you have earned a profit of, let's say, 4,900. The average rate for the period was 4.2. So what happens is that 4,900 divided by 4.2 will give you 1167. The exchange gain or loss is balancing figure. So for the closing net assets is gonna be 24,900 divided by, let's say, if the closing rate is 4.28. So this is going to be 5817.8. 5817.8. Now the balancing figure is going to be your exchange gain or loss. So it's probably going to be a loss in this case. It is going to be 349.2. What is it going to be? 349.2. So I bet it is actually going to be what? 349.2. Right? You get my point. 349.2. Now where is this exchange gain or loss going to go to? It will go to OCI. It will go to OCI. So that is all about the queries that you had with respect to this. Now what I'm actually going to do is that I'm going to now move forward and no, don't connect here. Okay. I'm now going to move a bit forward and what I will do now with you people is that I will actually I will actually probably try to see that in case if you people have got any specific queries, so I would actually give you answers related to your specific queries. Okay. Okay guys, good enough. Now, I've got many of you here. Ahmed Shayan, if you could actually let me know in case if you have got any queries, because what I have allowed you people is that you can unmute yourself. Whatever query you have, just let me know, I'll answer that. Plus, in case if you don't want to unmute, you could just write down whatever you want to ask. Okay, Melvina Mansara, the OCI exchange gain loss is going to be recycled to P&L upon disposal of this subsidiary. So if you've got a foreign subsidiary which is going to be disposed of later on, you will actually take it to P&L. Okay, Ahmad Shayan, you have anything? If you have, good enough. Or else I'll just move on to the next person. Okay, S. Rahman, I don't know what's your complete name, but for the embedded derivative, I've got a video prepared which I'm just going to share with you immediately after the class. I have got the contact details of all of you because you people have registered with us for this meeting. So we do have the contact details. We're just going to share the embedded derivatives video. Okay, Anis, very difficult. Very difficult to predict that what is going to be examined. Okay, Anis, you have anything to ask other than this? Okay, what about the current issues? There are several current issues. If you haven't gone through those current issues, just go through the videos that I've shared in the group. There is a link with respect to the different things, and there are multiple current issues videos also, like crypto, crowdfunding, and the impairment of financial asset, things like that. You have them in the WhatsApp group. And for those of you who don't have it in the WhatsApp group, maybe what I'll just do is that I will share with you people immediately after the class. So these are the two things that I have to share probably. Okay, Mr. Saidu, you're asking about the scenario of question pattern. Okay, basically the questions are like this. One of the first question that you will get is a consolidation related question. It's a 30-mark question where you would have 15 marks approximately discursive portion pertaining to consolidation, and then 10-15 marks are pertaining to other areas. Question 2 usually is some accounting standard with ethics. Question number 3 is mixed accounting standards. Question number 4 is some part is current issues and some part is the accounting standard. That's what it is. Okay, what I would suggest you to do with respect to the questions is that go sequentially, and there is one very important thing which you should understand. At times what happens is that we spend time on those things I repeat, at times what we do is that we spend time on those things which we don't know. So like I always remember one thing, I always adapted this approach when I was a student, and I would say that every one of you can adopt this approach, which is an 80-80 rule, which is you attempt 80% of the paper and you attempt 80% of it correctly. So automatically your 80% into 80% is going to lead to 64%, and you just need 50%. So a lot of tutors, they have got this approach. They would guide you that 1.8 marks, 1.8 minute per marks and things like that. Okay, that's time management. You could just allocate that 45 minutes for a 25 mark question. That's what it is. But believe me, a lot of us, what we do is that we just try to do those things which we don't even know. Like if there is a 25 mark question and you don't know 5 marks out of it, you may end up in spending 10-15 minutes trying to attempt that, and even after spending 10-15 minutes you might end up attempting it incorrectly. So it's better to skip that part, move on to the next part. Try to invest your time onto that. Remember this 80-80 rule. This means that you attempt 80% of the syllabus, you attempt 80% of the paper, and you attempt it 80% correctly, you'll surely pass. So I'm a strong believer about, if you don't understand, move on. I don't believe in that attempt 100% paper. I don't believe in that. I believe you attempt whatever that you attempt it solidly, so that you are able to gain passing mark. Like in the initial phases, when I was actually the student, in the initial phases, I used to complete 100% paper because I knew I had time to study. But when later on at the professional stage, I was doing job simultaneously, I never had time to study. So I remember I never did 100% paper. I always skipped some 10 mark, 15 mark, 12 marks, something like that, and I always ended up passing the papers. There was only one reason that I ended up passing the paper that I realized, which is whatever I did that solidly. That's what my approach was. Okay, so if anyone else would like to ask any question, you are most welcome to ask. I can just call out your name: Winston Hines, Tafadzwa Rosera, Sarah M. Kisan, Sanaullah Kaisare, Olaju Moke, Mustafa Gadit, Arslan Tariq Fiaz, Melvina Kodakwishe, Gloria Chipu, Buemba, Bolu Watafi. I'm sorry I'm pronouncing your names incorrectly. If I'm pronouncing your names incorrectly, I'm really sorry about that. Okay, because if you have questions, Fiaz, yes, you can please go ahead. Mm-hmm. Mm-hmm. Okay. Number one point is that when it comes to IAS 40 investment property, so what actually happens is that you don't have to mix it up with the IFRS 16 right now. First of all, you have got an investment property. It's a property that you have held for capital appreciation or for leasing out to others. Now, if you have actually held it for capital appreciation or for leasing out to others, it's an investment property. That's one thing. Now come to IFRS 16. The arrangement that you have entered into with the tenant, you are able to classify that as a finance lease. So when you are able to classify that as a finance lease, so what would happen is that you would then de-recognize the investment property, and you would actually recognize the lease receivable, and the lease rentals that are going to be received, you will split them into the rental income and into the recovery of lease receivable. The balance amount of lease receivable shown in your financial statement, you would split it into the non-current and the current portion always. I hope that clears the question. Okay guys, anyone else want to ask anything? You could just type out also, or you could unmute, whatever that suits you. Okay, so I'm actually going to wait for 1 or 2 more minutes before I conclude. So I do understand one thing, that a lot of you people have actually, you needed the revision. I realized that I was getting a lot of queries on the group accounts, so I specifically conducted this session on the group accounts, because people, they have a struggle in revising the group accounts because it's a long area, having multiple things to cover. So now I've actually gone through the group accounts, plus a lot of people, lot of video links that I've already shared in the WhatsApp group. I will also share in the caption on the videos which are available on YouTube and which is available on the Facebook, that this current class is being streamed. So I would like to thank all of you for attending the session today, and I hope that it was a beneficial session for all of you, and I wish all the best to you people for tomorrow. For the time being, like whatever the limited time that you have available, just don't try to take up new areas unless and until you are done with your rest of the syllabus. If you are not done with the rest of the syllabus, then try to focus on the areas in which you are weak. Don't try to take up the new areas. So okay guys, thank you very much. I hope that you enjoyed the session and that it was a beneficial session for you people. You're most welcome. Thank you.